Government budgets are supposed to serve as tools for long-term economic stability, yet in many countries they have turned into rigid frameworks built on arbitrary numerical rules, such as fixed deficit caps, debt ceilings, or spending to GDP ratios. These rules are often adopted to reassure financial markets, control political spending, or signal fiscal discipline. However, when they are designed without flexibility, they can do more harm than good, creating a growth trap, where governments cut essential investments just to meet short-term targets. The economic problem is simple. Not all spending is equal. Borrowing to fund wasteful projects or election promises can certainly damage an economy, but borrowing for infrastructure, digital transformation, energy transition, healthcare capacity, or research and development can raise future productivity and expand the tax base. Arbitrary deficit rules ignore this difference. They treat every dollar of spending the same, even when some types of investment generate strong returns. This problem becomes especially visible during crises. In recessions, governments need the ability to spend more to stimulate demand, support households, and prevent business failures. But strict budget rules often force premature austerity, delaying recovery, increasing unemployment, and lowering long-term GDP potential. The European Union's old Stability and Growth Pact is a classic example. The 3% deficit and 60% debt targets pressured countries to slash spending even when economies were weak, resulting in slower post-crisis recovery. A smarter approach begins with distinguishing between current expenditure and investment expenditure. Many economists argue that investment, especially in climate transition, education, innovation, and infrastructure, should be treated separately from day-to-day consumption spending. A golden rule of public finance would allow governments to borrow for investments that create future growth while requiring balanced budgets for operational costs. Second, rules should be counter-cyclical rather than fixed. Instead of hard numbers, fiscal policy could be tied to economic conditions. Deficits could expand automatically in downturns and shrink during booms. This approach aligns with how central banks use interest rates: flexible, data-driven, and adaptable. Third, transparency and accountability matter more than strict limits. If governments must justify every major investment with cost-benefit analysis, long-term projections, and independent review, voters and markets gain confidence without forcing damaging budget cuts. Fourth, international institutions must evolve. Global credit rating agencies and lenders often reward austerity even when it undermines development. Reforming these incentives is key, especially for emerging economies trapped between growth needs and debt pressure. Finally, political culture must shift from fiscal fear to fiscal intelligence. A healthy economy does not come from spending less, but from spending better. The question is not, how big is the deficit? But, what are we borrowing for? Debt that increases future earning capacity is not a burden, it is an asset. A new generation of economic thinking argues that the true danger is not governments doing too much, but governments doing too little of the right things. If arbitrary budget rules block green investment, delay digital transformation, weaken social safety nets, or underfund innovation, they are not protecting the future, they are mortgaging it. The path forward is clear: smarter rules, more flexible policy, and a long-term mindset. Fiscal discipline is important, but fiscal paralysis is deadly. Nations that learn this balance will grow stronger and more resilient, while those stuck in outdated budget dogma will continue to fall behind.